Welcome back to the Deep Dive. Today we're taking a really tactical look at a specific strategy, off-plan real estate investment, specifically in the UAE. This isn't just about general market buzz,
Yeah.
It's about being proactive, getting in before the crowd really shows up. That's where the advantage lies.
Exactly. The sources often frame this as moving before the asset's, let's say, full value has really crystallized. It's less about picking a nice apartment and more about reading the economic signs. And look, if you structure it correctly, off-plan in the UAE can be, well, one of the faster ways to potentially multiply wealth. You're aligning your capital with some massive development happening.
Okay, let's unpack that right away.
Right.
Why the UAE? I mean, if I'm a savvy investor, why not Berlin or Boston? What's the unique structural leverage, maybe in Dubai or Abu Dhabi, that you just don't find in, say, Western market?
Well, it really starts with the whole financial ecosystem being structurally different. The UAE is fundamentally built on attracting foreign capital, foreign talent, long term. And a huge piece of that, maybe the hidden leverage, is the tax situation. No ongoing property taxes. And crucially, no capital gains tax when you sell real estate.
Wow, okay. So that tax advantage alone completely shifts the ROI calculation compared to, high tax places in Europe or North America. Those annual costs and exit taxes can really eat into your profits.
Precisely. And that's just the baseline, right? Now, layer on top the aggressive demand drivers. We're not talking about slow growth cities here. Dubai alone is absorbing, over 100,000 new residents every year currently? That's a constant inflow of global talent needing housing. Construction just can't keep pace.
Right, so you've got demand consistently outstripping supply. And this is backed by massive infrastructure projects, economic diversification efforts. So what's the tangible result for someone buying early into a project?
Yeah, the sources are pretty clear on this. Because that demand is so intense and the supply takes time to catch up, off-plan buyers often, frequently, lock in units at prices maybe 20% to 40% below what similar ready properties are worth on completion. You're essentially getting a built-in profit margin from day one. It's baked in.
Okay, this is where it shifts from just buying something to, active strategic positioning. So the core idea is when you invest off-plan, you're essentially buying time. You commit capital early for the construction phase. What specific benefits does that early commitment unlock for the investor?
Well, you're funding the future, like you said. And in return, you get some powerful financial levers. Number one, the lowest possible entry price, significantly lower than the handover price. You also get access to really flexible payment plans, often just 10%, maybe 20% up front. And critically, you often get first pick of the premium units, the corner spots, the higher floors, the ones with the best views. Those always have the best resale value.
And that capital appreciation starts ticking up right away. While the buildings may be just a frame, we saw that really concrete example in the sources. A studio launching at, say, AED 699,000 in a developing area like JVC.
Shamir Village Circle, yeah.
Right, JVC. That same studio could easily fetch AED 900,000, maybe even 1 million dirhams by the time construction wraps up.
Exactly. And that appreciation happens before the investor has even paid the full price, often. Plus, if you decide to hold on to it long term, the potential rental yields are strong, maybe in the 7% to 9% range. That's quite exceptional on a global scale.
That definitely paints a picture of a high-return environment. But, it almost sounds a bit too good. What are the catches, the risks? You're dealing with maybe a 3-year construction timeline, potential currency swings, market volatility. A proper deep dive needs that balance. What do investors need to watch out for?
That's absolutely the right question. The biggest risks usually revolve around project non-completion, which is rarer now, or more commonly, significant delays. If the developer runs into trouble, your capital is tied up longer than you planned. Now, the good news is the UAE regulators have put safeguards in place, like escrow accounts. But it does mean these high returns aren't automatic. They definitely reward discipline, structure, diligence.
Okay, that discipline and structure lead us nicely into the professional strategy. The sources lay out, 7 critical steps. Steps that seem to separate the really successful investors from those who just maybe get swayed by a fancy brochure.
That's right. We can kind of break these down into 3 phases: vision, structure, and timing. So the first phase, vision, is all about clarity. Step 1, define your investment strategy. Before you even look at a single building, you need absolute clarity. Are you aiming for capital appreciation, like a quicker flip near handover? Or is the goal long-term rental income, maybe for wealth preservation? Because if you want appreciation, you're hunting for those undervalued launch prices. If you want rental income, you're prioritizing established high-demand communities, maybe even considering handover timing.
Makes sense. And that strategy then dictates the location, right? Which I guess is step 2.
Exactly. Step 2, focus on future hotspots, not today's headlines. Your location choice has to be forward-looking. Where's the new infrastructure going in? Are there planned metro extensions, new airport hubs like Dubai South, massive urban projects like MBR City? You look at areas like that. 5 years ago, they were practically undervalued plots of land. Today, they're booming because the government followed through on its plan. You have to map the future, not just react to the present.
So anticipate the growth. Got it. What's next?
Step 3 is absolutely crucial for managing risk. Study the developer's track record. Seriously. A great price means nothing if the project gets stuck in delays for years or the build quality is poor. You need solid proof of past performance. Check their delivery history. Did they finish on time? What's the quality like in their completed projects? Are they financially stable? Dig into it.
Okay, that's solid advice. So once you've got the vision, the future location identified, and you've vetted the developer, then we move into the structure phase, the money side. How do you get that leverage without needing a huge mortgage right at the start?
Right. Step 4, analyze the payment plan and its cash flow impact. This is really where you get that leverage without traditional bank debt, at least initially. You'll see plans like 60-40 or 70-30 quite often. That means the biggest chunk, maybe 40% or 30%, isn't due until the property handover. Sometimes developers even stretch payments beyond handover, maybe 10% a year later. This lets you control a valuable asset with much less upfront capital. It allows investors to scale portfolios much faster than with, say, an 80% mortgage requirement.
Okay, less capital tied up initially. And step 5 is about the safety nets you mentioned. Step 5, inspect legal protections and escrow compliance. This is non-negotiable. You must verify the project is fully registered with the Dubai Land Department or the relevant authority in another emirate. And the escrow account compliance is key. It means your payments are just handed over to the developer straight away. They're held independently and released only when specific verified construction milestones are hit. That drastically reduces the risk of a developer just vanishing with the funds, a huge protection compared to some less regulated markets.
Absolutely vital. And then the final 2 steps bring it all together, timing and exit, because even a great deal can sour with bad planning here. Step 6, assess the exit strategy. You need to plan for liquidity right from the beginning. What's the plan? Are you aiming to sell before completion to grab that early appreciation surge and maybe roll into the next launch? Or are you planning to hold, maybe refinance that final payment after handover and build a long-term rental portfolio? That choice needs careful modeling against your goals.
Right, you need that end game insight from day one.
Exactly. Which leads to the final step, step 7. Time your entry and exit with market cycles. Generally, the biggest appreciation jumps often come from getting in right at the launch phase or very early in construction. That's when you capture scarcity pricing. And if your goal is appreciation, the ideal exit window is often just before or very shortly after handover. That's when the asset fully transforms from a plan into a tangible, ready property, and the value reflects that.
Okay, that 7-step process really lays it out clearly. It provides a solid framework. But here's what feels like the big modern challenge. Just the sheer volume of information.
Yeah.
How does an average investor, even a sophisticated one, realistically filter hundreds of projects? How do they analyze all these different payment plans against potential ROI, navigate the legal details? It feels overwhelming.
You've hit on a key point, and this is where we're seeing the rise of what the sources call strategic investment intelligence platforms. They're becoming pretty essential. It's fascinating because the market is demanding more than just, basic property listing websites. These platforms, like Eland, which was mentioned in our source material, are acting more like sophisticated intelligence hubs. They're designed specifically to bridge that massive information gap you described, using specialized screening.
Okay, so what are they doing differently? What's the added value compared to just talking to a regular real estate agent, especially when it comes to forecasting returns or assessing risk?
Well, they tend to apply much more rigorous project selection criteria. They're looking hard at developer reliability, verifying the legal compliance, using data models, not just guesswork for ROI forecasts. And crucially, the advice is tailored. It's not just about selling a unit. It's about building a custom strategy. Are you after capital growth? Rental income? What's your specific capital, your timeline, your risk tolerance?
And I saw they're often negotiating better payment terms too, because they have direct relationships.
Sometimes, yes. Through those direct developer partnerships, they can potentially secure more favorable structures than an individual investor might get walking in alone.
And they're bringing in some pretty advanced tools too, changing how ownership itself is structured. Let's touch on SPVs and tokenization. Can you break those down quickly? What are they, and why should an individual investor care?
Okay, let's start with SPVs, special purpose vehicles. Think of these as dedicated legal entities, often like a small company structure. In high-value international real estate, they're frequently used to hold the asset, especially for foreign investors. Why? Well, they can help manage tax implications back in the investor's home country. They separate the property from your personal liabilities, and they can simplify things like inheritance or managing a portfolio across different countries. It adds a layer of financial structure.
Right, a professional structure for holding the asset. Now, tokenization. This sounds like the really disruptive one.
It absolutely is. Tokenization is the tech that's starting to tackle real estate's biggest historical problem, illiquidity. Buying or selling a whole property takes time, months usually. It's cumbersome. Tokenization breaks down ownership of an asset like an apartment or even a whole building into digital tokens on a blockchain. This allows investors to buy, sell, or trade much smaller fractional stakes in that property.
So fractionalization, that lowers the entry barrier.
Right.
Someone could potentially own small pieces of several different buildings, diversifying their risk instead of putting all their money into one unit.
Exactly. Diversification becomes much easier. And because these digital tokens can potentially be traded much more easily, maybe on secondary markets.
You inject liquidity into what was previously a very static, locked-up asset.
Precisely. You're effectively turning a physical asset into something closer to a tradable digital security. It opens the door to a wider pool of global investors and dramatically changes that exit flexibility we talked about in step 6.
Okay, let's try and synthesize this. The key takeaway seems to be off-plan real estate in the UAE, when approached strategically, still offers a pathway for individual investors to potentially achieve returns that can rival, maybe even outpace, big institutional players. Is that fair?
I think that's a fair summary. The formula seems to be buy that time element before the market fully prices it in, use the flexible payment structures to amplify your capital control, and then have a very clear, disciplined exit plan from the outset.
And this whole playbook is supercharged by the UAE's specific economic environment, isn't it?
Absolutely. The zero taxes, the welcoming foreign ownership rules, the residency incentives tied to investment, they all act as accelerators, amplifying the returns generated through this kind of structured, calculated approach.
So what does this all mean as we look forward? Well, thinking about these new tools we just discussed, especially fractionalization and tokenization, they're unlocking liquidity in ways we haven't seen before in physical assets. So it does raise a pretty fundamental question, doesn't it? How radically is our very concept of owning property going to change when you might be able to trade fractional stakes in buildings, maybe entire portfolios, almost as easily as you trade stocks on your phone today? Something to think about.